Okay. Three very quick announcements. One is that your DCF is due this Friday, right? So get it in. I've received about 12 or 15 already, so I've returned them all, I think. So if you've sent your DCF in and you haven't heard back, send it again, because you might not have put the right subject in the perfect DCF. So try to remember that when you send the DCF. The second is your next quiz is a week from today. We will be done with packet 1 on Wednesday. It'll cover everything from wherever we left off for quiz 1, which I think was around page 150 or so, around growth, right? We stopped at cash flows. Everything from growth till the end of DCF valuation will be fair game for the next quiz. So loose ends, bring things together in terms of doing a DCF. So all the mechanics of doing a DCF valuation. Last point, please remember to print off your second packet. I think if you go to the bookstore, they have the second and the third packets together as one packet. So get it as soon as you can or print it off, because we will be starting on Wednesday. Actually, halfway through the class, we will be starting on packet 2. Right? So let's finish up the loose ends on the dark side of valuation. I valued young companies on Wednesday, and we talked about the challenges of valuing young companies. Today we're going to bring in a bunch of other dark side evaluation companies, mature companies in transition, declining companies, distressed companies, emerging market companies, commodity companies. Let's think about what makes commodity companies challenging to value. You take even the most mature commodity company in the world, its earnings and cash flows go up and down as commodity prices go up and down, right? So given that that is the case, that earnings and cash flows go up and down as the commodity price goes down, I want you to think about PE ratios. Mechanism we use all the time to see if companies are cheap or expensive. And tell me what you'd expect to see the PE ratios of commodity companies do over time. So earnings go like this. What would you expect to see? So here are the choices. Stay constant. Increase as commodity prices increase. Increase as commodity prices decrease. Or something else. Yes, sir.
I think it depends on how long the commodity price is going down, or if it's like a short-term spike or a long-term spike.
So let's say it's a long-term spike.
Long-term, maybe stay constant, because even though your earnings would be going down, presumably the prices of your shares would also be going down.
So you're saying it depends on what commodity price is being built into the stock price, right? So if you're saying, if people think there's a normal oil price of $45, even if oil goes to 65, they're not repricing these companies at 65, they're leaving at 45. So if you look actually at the history of commodity companies, that was what used to be the case. But your point about the length for which this spike lasts is an issue, because in 2003, when oil prices first went to $100 per barrel, you saw price earnings ratios drop. But the longer oil prices stayed at 100, the more you saw price earnings ratios adjust. Now we're seeing another movement in the other direction, right? The question is this a dip before you go back up, or is this a long term? And we're going to see that, because I think right now we're in the middle. We're not quite sure, but markets are willing to accept the fact that oil prices are not going to go back to $100. They might not even go back to 70. So it'll be interesting to see how price earnings ratios behave. So one of the things we'll talk about today is valuing commodity companies given the uncertainty we feel about commodity prices. Second, say you're valuing a bank. Now we've talked about banks off and on. Let's say this bank is conservatively capitalized. It has a lot more regulatory capital than it needs to. So its regulatory capital ratio is well above the minimum. What would you expect to see in this bank's financials? And I'll give you the choices. High return equity, low risk. Low return equity, low risk. High return equity, high risk. Low return equity, high risk. What combination are you going to see if you have an overcapitalized bank? First, let's take the easier half. If it's overcapitalized, is it low risk or high risk? It's going to be low risk, so that's, But if it's overcapitalized, it also means that they have a lot more equity than other banks, so you'd also expect the return on equity to be lower, right? So when you first screen banks based on return on equity or regulatory capital ratios, what you hope for is that magical bank. You know what I mean by the magical bank? A bank with high regulatory capital ratios and high return on equity. So when you get a chance, if you get later today, go on S&P Capital IQ, because they actually have regulatory capital IQs as part, the regulatory capital ratios as part of the database. Start screening banks for banks with high regulatory capital ratios and high returns on equity. I'm not saying you should put your money in those banks right away, but that's an interesting mismatch. Finally, all of this that we're doing is to estimate a value for a company, right? Let's assume that you feel certain about your valuation of a company. Don't ask me how you got to that point of certainty, but let's say you feel certain. It's higher than the stock price. So you get ready to buy the stock. Should you forget all these things about diversification and just put all your money in that one stock?
No.
Why not? If you're certain about the value, what's the risk?
Well, there's macro risk associated.
Forget about the macro risk. Let's say you built it all in. Let's say you feel absolutely sure about the value. Alex?
You have to assume that the market will make that correction.
In other words, even if you're certain about your valuation, you know what you cannot be certain about is whether the market will adjust to it.
And when.
And when. This is actually at the heart. I actually wrote this post about diversification because this is a big issue at the heart of value investing. If you read a lot of value investing mavens, they feel that this diversification is the bad thing, that you should basically buy 3 or 4 companies because I think their argument is if you spread your bets, you're deluding yourself. I'll concede to you that there is a circumstance where you should not diversify at all. You know what that circumstance is going to be? When you feel absolutely certain that the price is going to adjust tomorrow, which is if you have inside information. If you're breaking the law, of course you should forget about this diversification thing and collect your money and run as fast as you can to a country without an extradition. Because that's the only circumstance where complete absence of diversification makes sense. Because everywhere else, your value is uncertain, you're uncertain about the price, and the more uncertain you are about the value and the price adjusting, the more diversified you need to get. Which means if you're buying mature companies like Procter & Gamble, you can get away with 6 companies, but if you're buying Facebook, Twitter, and Tesla in your portfolio, you need a lot more stocks to spread your bets because those are the stocks where you're most uncertain about value and price. So this feeds back into how diversified should you be? The answer will depend on what you're diversifying into. Being diversified doesn't mean you can't pick stocks. It just means that you pick stocks and you spread your bets. You don't put them all in one line. So all of these things we will talk about, but let's go back to where I left you on Wednesday when I was talking about mature companies. So we talked about what the difficulty with young companies is, right? Every question you ask becomes difficult to answer. What's your growth rate? I don't know. What's your risk? I have no idea. When will you be a mature company? I'm not sure I'll make it there. So every aspect of valuation gets more difficult. It should get much easier if you're a mature company, right? So if I gave you Procter & Gamble to value, it's been around a long time, you know exactly what it does. You should be able to use historical data to value the company. So valuation should be simple. That's true to a point. And here's why it's true just to a point. When you have a mature company, often managers get into habits. They do things the way they've always done them. And sometimes they get into bad habits. They do things they shouldn't be doing, either never borrowing or taking projects just because they've always done them. So you could have a mature company that is actually making money when somebody looks at the company and says, why are you guys doing this? Why do you guys insist on investing in this business which earns a 3% return on capital? And the answer you get from the managers is because that's what we've always done. So somebody says, why don't we change the way you run the company? Do you see how this makes valuation difficult? Is if you have a mature company that is on the verge of a transition, they'll make it specific. You probably read about the Heinz Kraft deal, right? You can do a valuation of Kraft right now with the financials you have, but it's only a work in progress because as you learn more about what 3G, which is the buyout partner is planning to do with the company, your valuation is going to be different. So think about it in terms of the 4 questions. When I ask you what are the cash flows from existing assets, you can look at the history, but that history reflects the way Kraft has been managed so far. We have no idea how 3G is going to be. When I ask you what's the value added from growth, again I can show you the history of Kraft, but I have no idea how 3G is going to approach growth. Maybe more emerging market, maybe it'll be different businesses. When I ask you how risky is Kraft, again I can show you the history of Kraft, but the company going forward could be a lot more levered in different businesses than the company going back. When I ask you, when will your company be a mature company? You might have already been a mature company when I did the valuation, but now after this transition, who knows, you might have growth potential. It means that when you sit down, every input you feel almost pulled in two different directions. One is the historical direction, which says use this number. The other is maybe it'll be different. And if you try to bring them all into one valuation, you're going to be a complete mess by the time you're done. So here's what I'm going to suggest. If you have a company on the verge of a transition, value it twice. Once based on what I call the status quo, with the historical patterns on reinvestment and return on capital and capital structure. Because ask yourself, if the incumbent managers ran Kraft, how much would it be worth? Then redo the valuation with 3G in place. So what would they do differently? And let's face it, we have some data on how 3G has changed the way Heinz is run. Maybe they'll bring the same techniques into play when they run Kraft. You get two valuations. So what am I going to do with that? If I'm an investor, let me give you an example. You guys familiar with Hormel? What's its most famous product? It's pork, but it's a very disgusting version of, I don't know, is it Spam? You know what Spam is, right? Spam is meat in a can that has a 100-year life. Think about it. Meat with a 100-year life. It was devised for the US Army as they were coming back after the Second World War from Japan, because they stopped off in Hawaii. And Hawaii at that time, and it still has this problem, did not have enough food to feed the US Army going through. They didn't have enough meat. So Hormel invented Spam as this meat for the army. And if you go to Hawaii, you actually get entire cookbooks based on Spam. Don't try any of the recipes. They're all disgusting. But Hormel's been around a long time. It is a very conservatively managed company. But there was noise in the air about change coming. So here's what I did. I first valued Hormel with the existing management in place. And here's what I mean by the existing management in place. The existing management doesn't reinvest very much money. They're very conservative. They don't invest outside the US. They invest in very few projects. They have a hurdle rate of 25%. Effectively, they've made up a number, and it doesn't mean it, they don't take it. They have a low reinvestment rate and a low growth rate. So I gave them that. They also use very little debt. Why? Because they're a conservative company. They don't like borrowing money. So with the low debt ratio and the low growth rate, the value per share that I got for Hormel was about $31.91. So let's call that the status quo value with the existing management in place. Then I revalued the company with somebody else. You're saying who? Anybody else. Anybody who could see the numbers and react differently. And basically here are the two changes I made. First is I assumed that they would reinvest more money than the existing management. So their reinvestment rate goes from 19 to 40%. But at a cost. Their return on capital is going to be lower because they will have to accept projects that the old managers did not. So lower return on capital, higher reinvestment rate. Their growth rate goes from 2.75 to 5.6%. And it's going to last a longer time because you've got a high growth window now. I also assumed that their debt ratio would increase to about 20%. And I'll come back and talk about how I came up with the 20%, because you can't just make up debt ratios just because you feel like them. I think they can afford to go up to 20%. What does that do? That lowers their cost of capital. See where this is going? I have a higher growth rate and a lower cost of capital. I redo the valuation with these numbers put in. Not surprisingly, because of a higher growth and a lower cost of capital, the value per share that I get is $37.80. I'm laying the foundations for something we're going to come back and talk about in a lot more detail, which is the value of control. Now, the value of control is that you can run a company differently, better than the existing management can. In this case, with the existing management in place, the value is $31.91. With the new management in place, it's $37.80. Let's say nothing's happened yet, right? Because all I'm hearing is rumors that this could happen. In the market, the stock was actually trading at about $30-something per share, $33 per share. And you can see the challenge I face. If I compare 33 to the intrinsic value with the existing management in place, it's overvalued. But if I assume that somebody else runs a company, it becomes undervalued. And here I've got to pull another trick out of my hat. I've got two values, right? An intrinsic value with the existing management and an intrinsic value with the new management. I've got to estimate a probability that management will change. And in this case, I attached only a 10% probability of management change. And here's why. You know who Hormel's largest stockholder is? It's the Hormel Foundation. The Hormel Foundation was actually created by the family because this is a family-run, owned company for a long time, so they're all now gone. But that foundation owns 21%. You're saying, so what? I took a look, because it's a public foundation, you can take a look at who is on the board of the foundation, and guess who the CEO of the Hormel Foundation is? The CEO of Hormel. See why I've attached such a low probability? Because if somebody challenges Hormel, one of the big players of this game is, what will the Hormel Foundation do? Who will they vote for? The incumbent managers or the people challenging them? And here it's a no-brainer. Corporate governance is not something we just talk about. In valuation, this is where it shows up, is in the probability that there will be change. If you're in a really, really weak corporate governance system, there's a 0% chance of change. Your value per share should just be the status quo value. If you're absolutely certain that there's going to be change, as is the case with, if you have to value Kraft, now there's no point in even doing a status quo value, because the status quo is done. Then you'd attach 100%. Most of the time, those investors, you're kind of assessing that change. And that's why when a Carl Icahn opens his mouth about a stock that he's taken a position in, if you're an investor in the stock, it's not like he brings some deep insight into the process. It's because he changes the probability of change happening. Doesn't even that he has to be successful, right? He pushes different managers. Maybe they will have a higher debt ratio because he challenged them, and it shows up as a different value per share. So this is actually a technique we're going to come back to, of valuing the same company twice. I know you haven't even valued your company once. But let's say you finish the valuation of your company and you come up with a value. Just as an exercise, it might be worth asking, if I ran this company, because as you went through this valuation, there were things you ran into and said, that's dumb, that's stupid, why are they doing that? There's nothing you could do about it because that's what they're doing. You can go through an exercise saying, if somebody more reasonable ran this company, what would they do differently, and see what the value is. And you'll have two values, and you'd use both in the context of investing. Any questions? Yes?
How did you get the 40% and 14% numbers? Were those just...
I made them up.
Okay.
The reality is I don't know enough about the business, but that's partly why, if you're an activist investor in a business, one of the things you need to do is actually invest heavily in learning the business. Mario Gabelli for a long time, for instance, went into telecom companies, because that's where, so you have to actually invest in learning the business. So when you say 40%, you'd have to say these are the investments. In fact, it's nice to actually have investments lined up saying these are the countries we're going into, these are the investments we're going to make. And that's partly what 3G Capital brings to the game that makes them so effective in the companies they're running, is they come in with a very clear vision. It's actually very simple. They're much more emerging market focused. So they take over companies like Heinz and Kraft, which have tended over time to be more too US focused. And the US market is a big market, but it's also an incredibly leveled out market. So one of the things they actually do is they talk about expanding into Latin America and Asia, and they come in with very clear plans on what that's going to involve. That's going to become your reinvestment rate. Any other questions? So three very, very simple lessons, though, I want to kind of emphasize before I leave this. Because whenever you hear about one of these companies being targeted by an activist investor, they always talk about how easily they can cut costs. We'll do this, we'll cut $2 billion in costs, $3 billion. They also talk about, almost cavalierly, about borrowing 5 times, 8 times, 10 times more money. So here are three things I want you to keep in mind the next time you see a company targeted. The first is, when you hear about cost cutting at a company, remember that most companies that talk about cutting costs don't do a thing. They talk about it, and they talk about it, and nothing happens. So this is actually from a McKinsey study that looked at what the variables are that differentiate companies that actually cut costs from companies that talk about cutting costs and do nothing. Most critical, and this is no surprise, is they have top management behind it, even when the costs cut close to home. They have clear targets. So when you hear people talk in diffuse terms of, we're going to cut costs, but we can't tell you where and how much, don't believe it. If they're going to cut costs, they need to be very specific. And essentially, you can go down the list, but you can see, in fact, when these press announcements come out, as to whether these cost cuts have heft to them. Incidentally, there was a Wall Street Journal article last week about what 3G does that allows them to cut costs. Did any of you read it? They use what's called zero-based budgeting, a technique that's 50 years old. And essentially, if you've ever worked at a corporation, you know how your financial plans as a division work, right? You start with last year's. divisional budget and you tweak. With zero-based budgeting, you're not allowed to tweak. You have to go and start with zero from every line item and justify every line item for zero. The reason most companies don't want to go through this is it's expensive but if you're a mature company, that might be one thing to do, is your inertia has driven you into these cost structures you should not be in. Maybe you should ask, should we be doing this in the first place? So next time you read about cost cuts, look at how much precision, how much detail there is, because that might give you some insight into whether those cost cuts will actually happen. Second, don't go for growth is good, because this is something we've kept talking about. Growth can be good, bad, or neutral with mature companies. Growth is more often likely to be bad than good. If any of you got a chance to read my GM buyback post last week, now one of the reasons if you've read about GM had that $5 billion buyback, one of the reasons I picked that as my example for talking about this is not a good example to argue against buybacks, is GM is a bad company in a bad business. I know that sounds harsh, but they are. They're a bad company in a bad business. They're a bad company even in their new iteration. I'm not blaming them for past history. Since 2010, if you look at GM, they peaked in 2011. Their revenues have dropped off. They've reinvested $22 billion. So next time somebody tells you, how come they're not reinvesting money? Fight them on it. So it's not that this buyback is coming at the expense of not reinvest. They've reinvested $22 billion, but their revenues have decreased and their operating income has dropped off. You can say, well, there are other, so you can come up with all the excuses you want, but after 5 years, there's nothing that I can see in the company that will lead me to believe that reinvesting more back into the company is going to help them. But if on top of that you bring in the fact that the automobile business is a horrible business. Horrible in what sense? In the last 10 years, 9 of the 10 years, the automobile business has earned a return on capital less than its cost of capital. 2005 was the only exception. Again, you can come up with excuses. There was 2008. There was yeah, you can come, but this is 10 years. Every single year, other than 2005, collectively, the company has earned less. The business has earned a return on capital lower than the cost of capital. Of course, if you bring this up to automobile companies, you know what their counter is. It's a bad company. It's dragging it down, right? So I took the 20 largest automobile companies in the world in terms of market cap. I think 4 of the top 20 earn more than their cost of capital. Only 1 of the top 10 automobile companies earns more than its cost of capital. It's Audi. Every other automobile company earns less than its cost of capital. Here's my definition of a bad business. If you collectively earn less than your cost of capital as a business, you're in trouble, especially if you do it year after. 1 year I can understand, 2 years maybe, 3 years, you can get away with it, but 10, 15, 20 years, you're in a bad business. Second, if the very best companies in your business struggle to make their cost of capital, you know what it tells you about the rest of the business, right? In fact, we're going to talk about declining companies today. And most of these declining companies happen to be in bad businesses. Brick and mortar retailing, automobiles. The worst thing you can do with these companies is to try to go for more growth, because if you go for more growth, what's going to happen? You're going to invest in projects where your return on capital is less than your cost of capital. You're going to pump billions of dollars into the ground and end up with a less valuable company than you did before you invested money. So that's the point of this graph, is every year, at the start of every year, I compute the return on capital and cost of capital for every publicly traded company in the face of the earth. It's this gigantic Excel spreadsheet. Okay? It's got 41,000 lines, actually 41,000 companies. It's every publicly traded company with a market cap available on it and S&P Capital IQ. I compute the return on capital. Remember the definition, after tax operating income plus book value of debt plus book value of equity minus cash. In fact, I capitalize leases, I capitalize R&D, I throw them all in, I come up with an adjusted return on capital. I compute a cost of capital and I cut some corners. First, I do everything in dollar terms because it makes comparisons easier. Second, I give the company the equity risk premium of the country it's incorporated in. Something I would never do if I were valuing the company from scratch with 41,000. There's no way I'm going company by company breaking it down. But I come up with the cost of capital. So some companies I'm going to probably overestimate a little, but I can't be overestimating all of them or underestimating all of them. I compare the return on capital to the cost of capital. You know the question I'm trying to answer? If you're a publicly traded company, do you generally beat your cost of capital, make your cost of capital, or earn less? Because I really don't know the answer. I heard different people with different agendas saying different things. If you listen to Marty Lipton talk, You know who Martin Lipton is? He invented the poison pill. Right? He's the Darth Vader of corporate governance. A man who believes that managers should never be challenged by stockholders. He truly believes that. He thinks that activist investing is a huge waste of resources. And he's been very vocal about this. And guess who gives him a forum? The Harvard Business Review. Yeah. No surprise there. No. So he says, no, you know what? We should stop this. We should not let stockholders challenge managers. And he builds it on a very simple theme. He says, most companies are well managed. He asserts that right off the top without any evidence. Most companies are well managed. Why do we make managers' life so miserable? By making them answer questions that stockholders have for them. Traces of Marie Antoinette and let them eat cake kind of thing, right? This is why you have the French Revolution. So the first time I was actually on a panel with Marty Lipton, he said this, and I knew fundamentally, I said, no, do you have any evidence to back it up? And he said, I don't need evidence. I talk to a lot of managers. I said, oh, thank you. That must give you a lot of insight into how good they are. So that's when I started looking at these numbers, because the next time somebody tells you most companies are well managed, pull this graph out. Because here's what the graph shows. I actually just focused in on companies with a market cap greater than 50 million, because if I bring in the companies less than 50 million, things look even worse. But then you can blame me, those are young companies, you can't. So I focused on 50 million or higher. There were 21,711 companies with market caps of 50 million or higher across the globe at the end of 2014. Using 2014 numbers, 11,722 of those firms earned less than their cost of capital. The median publicly traded company globally earns less than its cost of capital. And if you break it down by region, in every part of the world, you see this blue column? Those are the companies that earn a return on capital more than 5% below the cost of capital. If there were any justice in this world, that group would be targeted by activist investors for change. But there's no justice in this world. In big parts of the world, including the US, those companies are protected by either having two classes of shares or corporate governance restrictions. That's who you're protecting when you say, hey, no more activist investing, no more challenging managers. It's those companies. So when you see a mature company announce that they're going to try to go for more growth, be very, very scared. As a stockholder in the company, history suggests that when they go for more growth, it's almost always going to destroy value. Which brings me to my final point. And this, if you've been in my corporate finance class, you went through the process, but I'll very quickly review how you decide whether a company can borrow more money or less. First, dispense with the notion that borrowing always brings down your cost of capital. That is not true. We know it's not true, even though people throw it around. You know why that delusion continues? Is because a lot of LBO guys use what's called the APV approach to valuation. And the APV approach, if you remember in corporate finance, it's the unlevered firm value plus the tax benefits of debt. But if you do it fully, what should you, the last item? So unlevered firm minus the expected bankruptcy cost. If any of you work with PE guys, here's what they do. They start with the unlevered firm value. That was easy. They add the tax benefits of debt. That was easy. And they get to the expected bankruptcy cost. And here's what they do. It's too difficult the way that. Let's ignore it. So let's say you took all the good stuff from debt. You're saying there's no bad stuff. So you know what will happen to your value as a firm as you go from 10% debt to 20% debt to 30% debt to 40% debt to 90% debt to 97, 98, 99, 99.95. There is nothing, nothing in this process that pushes back. If you're going to use the APV approach, at least do it right. Doing it right means you've got to ask tough questions about bankruptcy probably. You're saying, that's so difficult. Hey, you were the one who dug this hole. Now get out of that hole, because if you want to use the APV approach without the expected bankruptcy cost, and of course they'll throw around things like, if the debt ratio changes, you cannot use a DCF valuation. Says who? I mean, in every one of my DCF valuations, the cost of capital changes over time, but somehow the APV, cost of capital changes over time, you can't. No, that's not true. You can use the DCF valuation, DCF value, even when your cost of capital changes. But in the cost of capital approach, here's how you bring the pluses and minuses of debt. When you borrow money, what's the plus? You replace more expensive equity with cheaper debt, right? That's always going to be the case, whether you go from 0% debt to 10% debt or 90% debt to 99% debt. And there's a very simple, intuitive reason for that. You're saying 99% debt, wouldn't my cost of debt be astronomically high? Yes. But the equity guy is still behind you in line, right? So if your cost of debt is 28%, guess what? If I'm behind you, I charge 35%. So that's a plus of debt, is debt less than equity. Just minus. Every time you borrow money, both your cost of equity and your cost of debt are affected. Let's think about the easiest side first. You know why the cost of debt is affected? Is you go to a bank and you say, I'd like to borrow money. At 10% debt, they set an interest rate, they set you the loan. You go back 2 days later, you're now at 20% debt, you try to borrow from the bank again. They're not going to lend you money at the old interest rate. They say, now you're more highly levered, here's a higher rate. And as you get to higher and higher debt ratios, the cost of debt is going to go up. Now think about why the cost of equity is going to go up. The equity is the residual claim on the firm, right? So if you have a 100% equity firm, you might feel pretty comfortable. You sleep well at night, your earnings are positive, you don't have debt payments to make, your cost of equity might be 7%. If I do a leverage buyout of that firm and you now have 90% debt, it's the same company, but as the equity invests in the company, you get whatever's left over after those debt payments. Your cost of equity is going to be much higher. What I'm trying to say is if you're going to do the cost of capital for a mature company and change the debt ratio, please don't leave the cost of equity and cost of debt fixed and just change the debt ratio, because that'll always make it look good. So here's what I had to do for Hormel. At every debt ratio, I computed what the cost of equity would be. And the way we've structured it, it's pretty straightforward, right? You have an unlevered beta coming from the business you're in. The levered beta reflects that unlevered beta and the debt to equity ratio you have. So the more you borrow, the higher the levered beta becomes, the higher the cost of equity becomes. And here's what I did for the cost of debt. I could call S&P and say, can you give me the rating for this company at every debt ratio from 0 to 90%? But I can tell you what they're going to tell me. Do it and then we'll tell you. They're not going to telegraph it. So here's what I did. I cheated. Remember those synthetic ratings we computed for companies? I took the interest coverage ratio. That's basically what I did. I came up with a synthetic rating for Hormel Foods for every debt ratio from 0 to 90%. I netted out the tax benefit. You're saying, why is the tax rate changing? Why is my tax rate changing at 80 and 90% debt? First, is that a good thing that my tax rate is going down? Not in this context, right? What am I doing? That's my tax benefit from debt. You know what's happening at 80 and 90% debt? My interest expense actually exceeds my operating income. So I'm saying, that's it, your game's over. Another problem I have with a lot of LBOs where people just take the entire debt and say, I'm going to get a tax benefit. Hey, first show me you got operating income, otherwise this tax benefit is not there. There's my after-tax cost of debt, and I compute a cost of capital. And my cost of capital is actually minimized around 30% debt. They're right now at 10% debt. I stopped at 20%. You see why I stopped at 20%? Getting from 20 to 30% debt barely budges my cost of capital. So why keep pushing the edges when I'm not getting much change? So my use of 20% debt for Hormel reflected the stable. So if I give you a mature company, if I gave you Kraft and say, well, what debt ratio can 3G have? Don't look at industry averages. Don't listen to target debt ratios. Do the cost of capital breakdown. You get a sense of what this company can afford to borrow. I mean, it can borrow more if it wants to, but its cost of capital will actually be higher as a steady state company. Okay? Any questions on capital structure or debt ratios? Yes, Nick.
A money-losing company today that you expect to
wait till you make money till you borrow money. Okay. Right? Of course, that might not be a choice. You might have to raise the capital, but don't operate in any delusions. That debt is not helping you right now when you're losing money. Eventually it might help you, but if you had your choice, you would probably have waited till that. That's why it never makes sense for a young startup to go out and borrow money. Now, issue preferred, issue convertible preferred, issue equity, do whatever you want, but don't commit yourself to this interest payment because you get none of the pluses of debt and a lot of the minuses. Your valuable business might be truncated because you borrowed. Okay. Any other questions? Now let's talk about decline and distress. Some of you are valuing companies which are in decline. We talked about the life cycle of a company. I'll tell you the biggest problem with valuing companies in decline is psychological. It's truly depressing valuing a JCPenney. Because there is no light at the end of the tunnel. You keep hoping, if that happens, what if this happens? In fact, somebody asked me, well, can you think of a scenario where GM could go back to growth? I tried and I tried and I tried, and finally I said, you know what, I can't, maybe you can. So it's almost psychological, because we're much more comfortable putting positive growth rates, right? We're much more positive making small numbers into big numbers. We don't like making big numbers into small numbers. And it's not just us. CEOs don't like to make big companies into small companies. What is it that Winston Churchill said at the end of the Second World War? He said, I want to preside over the breakup of the British Empire. He said, I wanted to build the empire up, not break it up. And a lot of CEOs have that same, no, I want to make this company bigger rather than smaller. It seems almost like you've given up to make your business smaller. So when you're valuing a company in decline, that's the first hurdle to get over, is to get over the fact that when you look at the history of the company, here's what you're going to see. You're going to see declining revenues and probably shrinking margins. Why? Because its business is being eaten away while you're looking at it. When you do projected growth, you're saying, what projected growth? The business is going to keep getting smaller. Your revenue growth could continue to decline. And rather than put money back into the business, what should you be doing if you're in a declining business? You should be doing what GM is doing, taking money out of the business, making your business smaller. Hopefully the light at the end of the tunnel is maybe there's a slimmer version of your company that could exist out there that could go back, not even to making money, to earning your cost of capital. That's really all you're hoping for, right? And in doing this, though, as you kind of get out of this business, you're going to be getting cash out of the business, and you're going to decide whether to use that cash to pay dividends or buy back stock, or return cash to your lenders, pay off debt. And that's going to affect your debt to equity ratio. You see why that's going to create a problem? Is when you do your cost of capital, you're going to have to keep track of that. So let's start with a declining company. I'm going to pick, and in declining companies, as I said, the key is to recognize that your revenues are going to decline. As your revenues decline, you're going to shut down portions of the business. And given a choice, you'd like to shut down the bad parts of your business and keep the good parts, and hopefully get to a point where you're okay with what's left in the company. So I'm going to value Sears using this from way back in time, like 5 years ago. And then I'm going to talk about what your nightmare scenario is as an investor if you invest in this company based on the valuation. It's not that they will shrink, but that they will fight shrinking. That is your biggest worry with these companies. If you invest in a declining company, in a declining business, and it insists on pumping in more money in, only bad things can happen to you. Do you read the latest BlackBerry annual report? Revenues have dropped by what? The guy talked about profits. The business is basically shrinking as he's watching it. The only thing that's selling are the old BlackBerries, not the new BlackBerries. Everything in that report basically was, this business is going away. Right? I mean, and it's been the news for the last 5 years. You've been getting it. But for most of those 5 years, you've had BlackBerry's managers saying, no, they're in denial. So let me take Sears and take you through a valuation of Sears, looking at it as I saw it then. And I did this just as Eddie Lampert actually made a big move for Sears. And we'll talk about what motivated that move. Stock was trading at $76.25. It had, for years now, revenues have been flat or shrinking. Margins have been under pressure. It was still making money. So basically I had after-tax operating income and free cash flows. But going forward, here's what I projected for the company. I assumed a reinvestment rate of minus 30%. You say, what does that even mean? It means that they're taking cash out of the business. They're shutting down bad stores. And when you shut down bad stores, the return on capital of those stores is what... So if you think about return on capital times reinvestment rate, it actually works in a very perverse way. The reinvestment rate is negative. You're shutting down your worst stores. So basically the effect of that is a declining operating income for the next 5 years. And then I made the optimistic assumption that if Sears did this for 5 years and made itself a smaller business, that smaller business would be able to at least earn its cost of capital beyond year 5. We'll talk about what if that's not the case. What if you don't see even that end game? So what I've assumed after year 5 is essentially a stable growth firm, a much smaller stable growth firm that will earn its cost of capital in perpetuity. So, yes, Joseph.
Sorry, is the return on capital here, is that of
The stores you shut down.
Okay.
So basically when you do your growth, So because you want a low number there, right? Because then your reinvestment rate leads to, because if you have a high return on capital and you have a negative reinvestment rate, then it's going to go. Yeah, so you're assuming that they will do the sensible thing, shut down the bad stores, and what's left of their stores will be the ones that earn their cost of capital.
Okay, so this would be like the return on capital of their lowest performing.
Exactly. So what they'd actually have to do in pragmatic terms is take all their stores, rank them in terms of return on capital, and start knocking. These would probably be the stores where there's a lot of invested capital in them, which mean your stores in big cities, because the big capital here is in the form of lease commitments, right? So you want to get out of the big lease commitments and stay with those stores that are on Route 54, Route 36, where you're not paying much for those leases, where you can continue to earn the return on capital. Because there are not going to be big differences in margins across stores. It's got to all come from how much capital do I have invested in the store. So the key is it looks very much like a conventional valuation, but you have a negative reinvestment rate and a low return on capital giving me a negative growth rate. At the end of year 5, I make them a mature company. Discounting these cash flows, I used more conventional cost of capital. It wasn't a big deal, so I could have used different debt ratios over time. But they gave me no indication they were going to bring down equity or bring down debt, so I've kind of left it at the debt ratio. Bottom line is, with those numbers, the value that I get for the operating assets, 17.6 billion, add cash, subtract debt. Here's one of the glories of valuing a company in decline. Those options are probably going to be worth nothing because they were granted when their stock price is actually something. So one of the few bonuses you get as an investor is the options are worth nothing. Value per share that I got was $87.29. I told you Eddie Lampert had just taken a big position in the company. What was his original rationale for? It was going, the real estate. He never thought that Sears was actually going to make it as a, and here's where he miscalculated. One was in timing. You see why I miscalculated timing? Making a real estate bet in 2008 is a terrible idea. No, I don't blame him for that. It just happened. The second is it turned out that the real estate that Sears is trying to unlock is a lot messier. It's not like you can sell the land. Much of this is in long-term leaseholds with tremendous covenants and constraints put on them. So he's actually, I think, regretted this decision big time since he made it, because a lot of the pathways he sought to value were not as easy as they look. And that you can say in general about these mature companies. They have deep roots, and it's very difficult to uproot them and kind of make them into different companies. Any questions on this? So some of you, this might actually be something worth doing, is thinking about declining revenues and stabilizing margins for your company. So if you're valuing a brick and mortar retailer, whether it's Radio Shack or JCPenney or whatever the company is, you might actually have negative growth. It's not a problem. That's the way this company will evolve. And as I said, the biggest problem for you as an investor is the managers here decide that they're in denial and try to open new stores and keep growing in this business. Then you're royally screwed, because then your value is actually going to get to 50 or 40 or 35 very quickly. In fact, 5 years ago, I did a valuation of BlackBerry where I was rather cruel. I said, so then BlackBerry had all these plans to make all these new phones, and market value was about 7 or 8 billion. When I did this, I said BlackBerry should kind of give up on the big market because you can't compete against Apple and Google. They have deep pockets. No. I said what they should do is go for a niche market with a single product called the BlackBerry Boring. And all you can do on this phone is check emails and check more emails. And then approach security conscious companies. You know, let's face it, companies freak out with your iPhones and your Androids. They don't know what you're doing. So what you can do is go to Morgan Stanley and say, all these iPhones, they're reducing productivity a lot. Why don't you give every employee when he walks in has to drop his iPhone or Android or her iPhone or Android into a big bucket, and will be handed the BlackBerry of the day. And all they can do all day is work. It's a niche market, but it's a pretty lucrative market. And I said, no, just fire the R&D people. What are you going to do? This is not fancy stuff. You keep the old keyboard for the 65-year-old somehow. That's a competitive advantage they have. Is it BlackBerry thumb is really good? No. And liquidate yourself over 5 years. And I mapped out a plan of liquidation, and I came up with a value of 10 billion. Of course, they didn't take my advice. They tried to put money back and come up with BlackBerry. Well, I remember the BlackBerry tablet. I don't even know whether it still exists. No, BlackBerry this, BlackBerry that. But companies fight. I mean, we all do, right? Who wants to go old? So companies fight getting old. They fight that you got to shrink and become smaller. But they do that as an investor. And that's what if you're a BlackBerry investor, that $7 billion has now become what, $2 billion and falling. That's exactly what's going to happen, is you're going to see the value of your company shrink as it the harder you try to grow, the worse it is for you as an investor. Now, of course, there is another thing to worry about when you have a declining company, especially if it has a lot of debt, which is that you might not be able to make those debt payments. Joseph?
Sorry, going back to the last slide. What does it mean in this context when you're a mature company? Does that mean that you've stopped shrinking your company?
Yeah, basically there's a slimmer version of your company that is out there that could survive, not even make excess returns, but earn your cost. There's nothing wrong with earning your cost of capital. It's just running in place, but that's fine. And
for stable growth, you said 2%. Shouldn't we say like 0 or just
doesn't matter. It doesn't matter, right? Because the return on capital is equal to the cost of capital. You know what happens to growth, right? It disappears. So I might as well have left it at 0 if I wanted to, or -3. It doesn't. The interesting question is, what if that end game is not even that optimistic? You know what I mean by that? What if you don't see a J.C. Penney as a slimmed down version? Then what do you need to do at the end of 5 years? Liquidate. And I'm not even sure what that will involve, basically getting out of your leaseholds. So if that is in fact the end game, that is in fact the end game. You can't fight it. You're saying, but I'm doing a DCF valuation. Liquidation valuation is a DCF valuation. You're still okay. Just don't apply a multiple of 6 times EBITDA, because that will definitely get you into trouble with a distressed company.
Well, why can't you just assume that the returns on capital are lower than the cost?
You could, but then you have a value destruction in perpetuity, right? And if you have a management that's insisting on doing it, you could do it, and basically a value will decline over time. And the more they try to grow, the further down it will go. Right? And I think that's, if I were working with it, and we'll talk about this in emerging markets where you have no chance of replacing management, I often do that. If you have a bad management entrenched and they continue to destroy value, there's no reason they'll stop after 5 years. They're an autopilot, right? They might keep going. Now let's add a troublesome aspect to a declining company. What if it has a lot of debt? And what if you start worrying about the company not making it? And this is something we talked about at the start of last class. If you have distress and you're worrying about a company not making it, a DCF valuation will overvalue the company because you're valuing that company as a going concern. And I suggested you do 2 things. One is estimate a probability that your company will not make it, and second, estimate what you will get as an equity investor if you don't. Sounds like I'm working in abstractions, but let me give you an example. From way back in time, February 2009, I valued a company called Las Vegas Sands, one of the fastest growing casino companies of the last decade. Company headed by, you know who? Sheldon Adelson, who owns 52% of the company. And casino companies collectively are run by egomaniacs. You look at Steve Wynn, they're all run by these people are very willful. They do whatever they want to do. And in the early part of the last decade, Las Vegas Sands was growing and was growing well, building new casinos in Macau and Las Vegas. And they were borrowing money. Tremendous amounts of money. What choice did they have? Well, they did have a choice, right? Instead of borrowing money, what could they have done? They could have raised equity to build those casinos, but if they did that, what will happen to Sheldon Adelson, 52%? It'll become 48%. So control kind of became a factor, and they borrowed huge amounts of money. And even as late as 2007, people weren't worried about it because you said huge amount of debt, but they're a growing casino company. And then you had the crisis in 2008, and the bottom fell out. So this was a valuation that I did of Las Vegas Sands with lots of rumors swirling around the company would not make it. So file that away. I did a conventional DCF valuation. In what sense? I dug the company out of its hole. As I said, it's easy to do on a spreadsheet. Basically, you make the negative margins into positive margins, the high debt ratio into low debt ratio. And before you're done, you have a nice healthy company on your spreadsheet. I came up with a value per share of $8.12. That's my DCF value of Las Vegas Sands, assuming what? That it makes it as a going concern, goes back to health. And I look at the stock price, and it was at $4.25. So ask me the question. How do you find out whether I actually believe my own valuation? Did I buy? And I've never had qualms about buying on my DCFs. On this one, though, I didn't even think about buying, which led to some soul searching, because clearly there's something about my own valuation that is not convincing me. What's holding me back? What am I worried about? It's not even the debt to equity. The debt to equity I can live with, but what comes out of the high debt to equity is that they might not make it. Remember all those stories I was reading about them not making it? Those are all swirling around. $8.12 is my value for a going concern, but what if it's not a going concern? So I decided to estimate the probability that Las Vegas Sands would not make it. That's going to be really tough to do. I went to the market that's fixated on this probability. Not the stock market, but the
CDS.
Well, there was no CDS in Las Vegas Sands. I went to the corporate bond market. I could have gone to the CDS market today, but it was a corporate bond market. I found a 7-year Las Vegas Sands corporate bond trading at 529. Remember, bonds have par value of 1,000. So this bond is trading at well below par value. Now, the way we normally price bonds is we take the promised coupons and discount them back at a risk-adjusted discount rate, right? Instead of doing that, I tried something different. I took the price of the bond. I took the expected coupon. You're saying, what the heck is an expected coupon? The company's got to be around to make the payment to me, right? So I took the promised coupon times the probability. I tried to smooth things out and assume that that was the same number every year for the next 8 years. And because I've adjusted my coupon for risk, I discount back at the risk-free rate. So I know the price of the bond, I know the promised coupon, I know the risk-free rate. What's the only number I don't know? The probability that the company will not make it. If you ever used the solver function in Excel, that's what I did. I said, solve for this. Because mathematically it's a nightmare to solve, right? It's 8 terms in an equation with all kinds of quadratic and root 3, root 4, etc. I solved it and it came back and gave me 13.54% a year. See, what does that even mean? To get my going concern value, I need to get to year 10, right? That's where nirvana exists, the big terminal value. And if I believe the bond market, there's a 13.5% chance I won't make it each year on a compounded basis. So to make it to year 10, the probability that I will make it to nirvana is 23%. Remember that going concern value of $8.12? That applies in the 23% of the time that the company makes it to nirvana. The remaining 77% of the time, the game is over. The company goes bankrupt. What does that mean? You're going to sell your casinos to whom? What are they going to do with casinos? You're going to sell it to Steve Wynn, who's in trouble at the same time you are in trouble. It's a collective problem, right? Which means that you're not going to get whatever you paid to build these casinos. If you're in collective trouble, you're going to get half of book value, 1/3 of book value. So here's what I did. I took a liquidation value for these casinos and I compared it to how much money they owed. And I concluded that if they ever went bankrupt, my equity is going to be worth nothing, which is not unrealistic. So my value per share is an expected value, $8.12 times 23% plus 0 times. And you can make this much more refined by bringing in expected proceeds if you go bankrupt is not. So there are some assumptions I'm making in the bond calculation you can very easily adjust. But the key is to come up with a probability of default, either from the CDS market or the bond market or even your own gut feeling on estimates. Estimate what your equity is going to be worth and take an expected value. Yes, Jordan?
Maybe I missed it. Where did you get the sale proceeds here?
The sale proceeds, I looked at 2 other casinos that had actually gone bankrupt in the previous 2 years. I looked at what they got as a percent of book value. It was like 50% of book value. I just took 50% of book value. I mean, if there might be, if you know what the buildings are and you can, so you know what cities they're in, and you can actually try to back out from the. But the reality is, when you're this highly levered, your equity is going to be worth nothing if this happens. Right? Any questions? So I know some of you are working with companies with huge debt burdens. You've done a DCF evaluation, you come up with the value per share, and you're very, very uncomfortable with that value per share because you're saying, what if my company doesn't make it? For the moment, don't worry about it. After you've turned in your DCF, start thinking about attaching a probability to the company not making it, either by going to the bond market or looking at a CDS spread, or even if your company has a rating. Ed Altman actually every 2 years publishes the probability by ratings class as to how many so I think, so if you go down at AAA companies, only 0.3% default in the next 10 years. But if you go all the way down to triple B, double B, single B, you can actually come up with a cumulative probability. So you can use that. Something to attach to that number and take the expected value. Now, whenever I do this, especially if we have DCF purists, the question I get is, aren't you double counting? You see what, it's actually a legitimate question, because if you're doing a pure DCF, where do we reflect risk? It's in the discount rate, right? You reflect as a higher beta or a cost. And my response, the cost of capital is designed to capture some types of risk, continuous risk, but it's really not designed to capture discontinuous risk. In fact, I'll go further. If you have a troubled company, here's what you should do. Value the company using a healthy company's cost of capital in that sector. Right? So take the cash flows, discount back at the healthy companies, so you don't have to deal with the 88% debt and the strange things that happen. You know? I think you're doing BEA systems, right? I mean, I don't know what the debt ratio is, but it's Caesar Entertainment. So another company that's basically, you do any kind of debt ratio or cost of capital, you get strange looking numbers, right? The interest rate is at 18%, the company's in default, the debt to equity ratio is 9,000%. If you try to do a cost of capital, you look at that number and say, what does this even mean? So take is there a healthy casino company? Find one, right? Find it across and take that cost of capital and discount your cash flows, and then deal with the distress through a probability that it will not be around, which is pretty high for Caesars, and that'll give you a value per share. It's a more tractable problem if you do it that way. Any other questions about distressed companies? Let's talk about emerging market companies. Again, let's frame it in terms of the big questions. What are the cash flows from existing assets? The biggest worry with emerging market companies, it's very much driven by what's happening to the country in which that company is in. So if you're an emerging market company in a country that's coming apart, bad things are happening, then you're going to see your numbers reflected. So Brazil's had a very tough 6-8 months. You're starting to see it show up in the numbers, right? So the macro effect is there. Second is the growth rate you attach to your company will be affected by what you think about the country. So for better or worse, all your numbers are contaminated, if that's the right word, by what's happening in the country in which the company is in. Put differently, if you're feeling optimistic about a country, the companies all look more valuable. If you feel pessimistic, all the valuations come down. So here are some of the things I'd like you to think about when you sit down to valuing an emerging market company, and some of you are valuing these companies. First is country risk is an issue, but view it like a scalpel. Don't just use the bludgeon. You're a Brazilian company, and we've talked about this, right? Look at country risk exposure, looking at whether this company that you're valuing is as exposed to country risk as a typical company. In fact, I gave you my Embraer value cost of capital from 2004. That was actually in the context of valuing Embraer as a company. And I would strongly suggest that you go back and value Embraer today. Because if its stock price is being pummeled, because Brazil is in trouble, it might be getting pummeled for the wrong reason. It's not a conventional Brazilian company. And the way I captured country risk was through the lambda. And I don't know whether you remember the lambda, but I looked at how Embraer's stock price moved with the C-bond, which is a measure of how much risk there was in the country. So basically, Embraer is not as exposed as a typical Brazilian company. The way this shows up is as a much lower cost of equity than you would get for a typical Brazilian company. And the value per share that I got was about 953, which translates into a real value at that time of 15.72. And that's the other overhanging issue, right? You invest in these countries and the exchange rate moves against you. You very quickly could lose a third of your value, 20% of your value, 40% of your value. And you have to decide whether you want to try to do something about it. You know what I mean by do something about it? Whether you want to go hedge that risk. I think over time it's not going to do much for you to hedge that risk, because whatever you lose in one period you will gain back in another. But if it makes you sleep better to hedge against nominal real dollar exchange rates, go ahead and do it, because that is going to affect what it does to your value per share. I mean, just on a personal note, I bought Vale in December at what, $8.24. You know what it's trading at right now? $5.50. You win some, you lose some. So far I've lost some. Right? But I'll still hold on, because a lot of that movement is, in fact, I picked Vale because I said go where it's darkest. It was Vale, Lukoil, and I don't know what the third company was. It's darkest because you have commodity risk, country risk, and currency risk, and they all have continued to get darker. And that's one of the problems. Going where it's dark is sometimes it'll get even more dark, before it turns around. But that's the second factor. Second, if you do your valuation right, it shouldn't matter what currency you choose to do the valuation in. That might sound incompatible with what I said about exchange rates, but at any point in time, if you choose to value a company in one currency as opposed to another, it shouldn't matter, because whatever one hand gives you, the other hand will take away. So if I switch from a low inflation currency to a high inflation currency, both my discount rates and my cash flows change, so it cancels out. So pick the currency that you're most comfortable doing valuation in, and value your emerging market company in that currency. Okay? And third, we talk about corporate governance. And let's face it, it's not just emerging markets, but emerging market companies are particularly susceptible to corporate governance issues because they have a long history of family-run companies where you have very little say in how the companies are run. In fact, that's the question I asked as part of the start of the class test last session, is should there be a discount? And we kind of agreed that if you do it right, I think Jordan mentioned that if you've done this right and brought it into your cash flows, that you have bad management, there's no need to have an additional discount. So I'll give you an example. It's a company again that I was asked to value once when I was in India. And again, these are people I've known a long time. It's a family-run company called Tube Investments. It's a South Indian company. Lots of different businesses. Probably too many businesses. They're in this, they're that, they're everywhere. So they asked me, can you come in and talk to us because we think the market's being very unfair to us. Because we're trading at 102 rupees and it's about 4.5 times earnings. They said, we're convinced we're worth a lot more. Can you come in and tell us that we're right? And I said, I can't come in and tell you that you're right, but I'll come in and do a valuation. And I can't guarantee you that your priors are going to be true. So I sat down, I projected the cash flows and a growth rate. And you can see the numbers that drove my growth rate is a reinvestment rate of 60%. So they're a company that's pretty active about doing acquisitions and growing. Earning a return on capital then of about 9.2% in rupee terms in 2000. And in rupee terms, their cost of capital at that time was 16.9%. You can already see the seeds of a problem here, right? They're growing fast by reinvesting, but they're reinvesting and earning a return on capital well below their cost of capital. But that's what they're doing. So status quo, I pushed the numbers through. In fact, I assumed that they would keep doing this. You're saying, isn't that the definition of insanity? Well, if you have incumbent managers running the company and this is what they've been doing, I left it there. The value per share that I got was 61.57 rupees. And I said, you should be lucky that the market's pricing at 102. But if I build in exactly what you're doing in this company, you should be really trading at 62. I put this up. They were not happy. They were looking for every possible way they could bring the value up. So the CFO was sitting in the front row, says, no, I think you've underestimated our growth rate. I said, what do you want me to do? He said, act like we reinvest 90%. I said, sure. If I raise the 60 to 90%, you know what's going to happen to the value per share? It'll go to 45 rupees per share. Why? Because the more you reinvest, the lower return on capital. Growth here is actually destroying them. It's not helping them because they're growing in really bad businesses. So he said, what should we do? I said, there are two things you can do. One is, maybe you can't do much about past investments, but at least on future investments, maybe you can start to demand a higher return on capital. So one of the what ifs I asked is, what if you could earn at 12%? Maybe it's too much to ask you to make 16%, but instead of making 9%, if you could make 12% of the new investments, your value will go up to 84 rupees per share. If it goes to 16.9%, your value will increase to 115 rupees per share. So the first thing you can try to do is, and you can't complain that these are past mistakes. These are new mistakes you're making. Maybe you can stop making some of those new mistakes. It's the first thing. The second is if you can somehow go back and fix your past mistakes. You know what I mean by fix the past mistakes? Push up the return on capital on your existing investments. Much tougher to do because you got to take that sugarcane factory you invested in 3 years ago, which you had no business doing, and try to push up the return on capital. Then the value per share can actually be even higher because you get that efficiency growth from the fact that you are improving your return on capital in existing investments. In other words, I'm using exactly the same techniques we talked about for fundamental growth to ask the question, what does this company need to do to increase value? And what it has to do is actually reassess what it's making on its projects relative to its cost of capital. You see where the corporate governance discount is already built in? And I leave the value at 61 rupees. What am I saying? These existing guys are going to continue running the firm. It's a family-run company. And in fact, that's the last thing I brought up is we're around the table and I said, I went around and asked each person their last name, and 7 of the 10 people had the same last name, and I said, maybe that's the problem. Is sometimes when you have a family-run company and you get into bad habits and there's nobody there who can challenge you, how is it going to change? So when you think about corporate governance, that's what you should think about. Finally, cross-holdings. We've talked about this in the context of what to do and how messy it is. Again, it's not unique to emerging market companies, but emerging market companies are often a complete mess when it comes to cross-holdings. Okay? They have holdings in each other, big holdings, 20, 30, and much of the time it's not deliberate, it's over time. It's happened because these companies supplied capital to each other 20 years ago, 30. It was an internal capital market. So the example I'm going to use, and don't try to read these numbers, is I valued 4 Tata companies. The Tata Group is one of India's largest family groups. And I valued 4 Tata companies: Tata Chemicals, Tata Motors, Tata Steel, and Tata Consulting Services. All 4 are Tata companies. They're part of the same family group. I did a conventional DCF valuation. That gives me the value of the operating assets, right? And then I brought in the cross-holdings. And I want you to focus just on that cross-holding aspect, because here's what I found. For TCS, 95% of the value of the company came from its operating assets. There's very little from cross-holdings. But if you look at Tata Chemicals, Tata Steel, and Tata Motors, almost half the value for Tata Motors and Tata Chemicals comes from cross-holdings. So when I buy Tata Chemicals and Tata Motors, I'm actually buying half company and half group. And for Tata Steel, almost a third of the value comes from cross-holdings. Why the difference across the companies? Anybody familiar with these companies that can tell me why Tata Consulting Services is a much smaller cross-holding problem than Tata Steel? And think about what I said about how these cross-holdings were created. They were created through
agreements.
It's actually through history where companies essentially, you know what the youngest company in this group is? Tata Consulting Services is a technology company. It's been around only 20 years. Because it's not been around a long time, it's really not had a chance to get into this capital gain. That's why you don't have the problem with TCS that you do with the older Tata companies. But it does make it a much more difficult exercise to invest in these companies because you're really investing in part company and part cross holdings. Any questions on? And finally, we talked about truncation risk, we talked about distress risk. With emerging market companies, you can also have other risks. I remember doing a valuation seminar in Antigua. Why was I doing a valuation seminar in Antigua? It was a really bad winter, I think, and I said, invite me anywhere that's warm. And I ended up in Antigua talking about valuation. It's all local business people, and we talked about valuation, and they kept talking about risk, and they talked about risk, and I said, what's this risk you're worried about? And they said, we're talking about weather risk, because you have a big hurricane that can, many of them are agricultural, tourist-driven businesses. One big hurricane can wipe out our hotel or our farms. It's truncation risk. Or if you're valuing a Middle Eastern company, truncation risk could be, hey, somebody can blow up my business, right? It's a big problem across the Middle East. I talked to somebody who actually owns an Iraqi oil business. I'm not kidding. She's actually doing very well because she's gone where it's darkest. Okay? But she said, this is my big worry is, I have oil fields all over, you have ISIS, and it could go up in flames tomorrow. Or it could be nationalization risk. You own a Venezuelan or Russian company, just don't do too well. Because then you attract attention, the next thing you know, it's not your company anymore. But with all of these, you have to do what we did with distress, which is if you worry about these risks, when you're doing your DCF valuation, it can paralyze you. Just value the company as if this risk doesn't exist, then bring in whatever you worry about, whether it's nationalization risk or terrorism risk or weather risk. Let me give you an example. Let's say you value Gazprom. Right? You come up with a value of 180 billion for the operating assets. You subtract our debt, you come up with 150 billion for the equity. If there are 15 billion shares outstanding, you divide the 150 by the 15, you come up with $10 per share. And then I say, oh, by the way, I forgot to tell you that the Russian government owns 42% of the outstanding shares. Saying, who cares? I've got the number of shares, I divide the value. Would that worry you that the Russian government is your biggest stockholder?
Yeah.
It'd worry the heck out of me. Because I worry about truncation risk. What if the rules change tomorrow? I said, well, you can sue. Where? Russian court? What am I going to get there, right? It's not justice. It's a big issue, right? If you're investing in a country where truncation risk is constantly behind, it'll make your value per share kind of a number that's completely shaky because it'll be 15 billion shares today, 150 billion tomorrow. You could wake up tomorrow and discover they've issued 135 billion shares with nobody's permission, and you now own, instead of 10% of the company, 1% of the company. Right? So emerging market companies are tricky, but don't let the uncertainty stop you. Go ahead and value the company anyway. Deepinder?
You said the best way to do it is to pretend the risk doesn't exist. And
When you do your
have a
DCF.
separate valuation.
Right.
But in some cases, like for example with nationalization risk, what if the country risk premium in the first DCF?
That's a problem. In fact, that's one of the things I worry about, because did everybody get that question? If you look at the Venezuelan rating and country risk premium, it's very unclear what that's captured. It's supposed to capture default risk, but let's face it, embedded in there are things like these risks are correlated. The kinds of countries that nationalize companies also create other policies that bring their ratings down. So you worry about, am I double counting here by putting in a big risk premium into my DCF valuation and then adding a value?
Or the beta could.
I agree, and I think that we do tend to double count with countries like Venezuela and Russia, because the rating reflects both. What you'd prefer actually is a rating based on economic risk,
Right.
and nationalization risk to be kept separate. So you might have to actually reassess the country risk premium that you used in the original valuation and then deal with the nationalization risk separately. It's not going to be easy, but in those countries, there's 4 or 5 countries where that's the big issue, you might have no choice. Okay. Any other questions on emerging market companies? Let's talk about financial service companies. I used to think financial service companies were easy to value. Pre-2008, if you looked at all my valuation books, the chapter in banks said banks are easy to value. And that statement was built on two presumptions. The first was that banks were run by sensible people. And the second was that the regulatory authorities did their job. That's what allowed us to walk away from bank valuations. See what each one brings? By assuming regulatory authorities do their job, you basically don't have to worry about risky banks and safe banks. All banks are regulated. They can't have risky banks. You can't do stupid things as a bank. That's run by sensible people, which means what they pay in dividends is what they should be paying. You're not going to be paying dividends if your regulatory capital is too low. Why would you be doing stupid things like that? So pre-2008, I used to value banks almost entirely using the dividend discount model. So I'll give you an example. It's a valuation from 2003 of ABN AMRO. Dutch bank, it's actually a global bank with a Dutch base. I projected the earnings, applied a payout ratio, discount back at the cost of equity, come up with a value per share. Implicitly, what am I assuming? I'm assuming that all banks are equally risky. I can attach a levered beta of banks to all banks. And that what they're paying out in dividends is what they can afford to pay out. So old-fashioned dividend discount model based on the dividend payout ratio, growth, so stand. But you can already see the dangers even in 2003. Let's go forward. 5 years, August of 2008. It's a valuation I did of Goldman. I've saved this valuation because anytime I get too full of myself, I take a look at this valuation, reminding myself I can make really stupid mistakes. August of 2008, a month before the crisis, I value Goldman using a dividend discount model. Much lower dividends. It doesn't have to be a big dividend, but because they're much lower dividends, they have a higher retention ratio and a higher growth rate. At some point in time, as their growth decreases, their payout ratio increases, just like in any other cash flow model. I discount back at the cost of equity. The value per share that I got was $222.49. Stock was trading at $169. All my money in Goldman, right? Actually, I think I was too lazy to actually invest. I wanted to, but I forgot. What a convenient forgetting that was, because 3 months later, you know what the stock was trading at, right? Trading at like 68, 70 when Warren Buffett came in and made that preferred stock infusion. dividend discount model where you're essentially trusting regulatory authorities to do their job and trusting managers to pay out what they can afford to in dividends. Well, I've learned that I can no longer do that. In fact, there are 3 lessons I want to bring home about banks. First is, banks are incredibly opaque creatures. What I mean by that is, try this out. Pick up the annual report for a bank, read the annual report, tell me whether you understand what risks they're exposed to. I have never been able to read a bank report and walk away saying that loans are risky or safe. There's an amazing amount of data, very little information. Banks are incredibly opaque. And for a long time we accepted that Faustian bargain. We accepted that opacity because we assumed the regulatory authorities would watch over them for us. So you can't go through a bank's financial statements and have the securities broken down by risk, because no, regulatory authorities might have that, but you and I don't. So here's a valuation of a bank from October of 2008. So the crisis has started. I'm still sticking with my dividend discount model. I'm almost afraid to let go because it's the only thing I know. It's a valuation I did of Wells Fargo, which was trading at about $33. And I picked on Wells Fargo because I kept reading these reports about how banks were now bargains because they dropped so much in price, which is actually the way most people find bargains or bubbles. Is a stock's gone up a lot, it's a bubble. If it's gone down a lot, it must be a bargain. So I decided to value Wells Fargo, and I made the changes that came out of the crisis. I gave them a lower growth rate, a lower return on equity, because I saw the equity capital ratios probably going up. The value that I got was actually $30.29. So the dividend discount model is not a bad model if your bank is being affected only by macro factors. It isn't doing something insidious underneath. The traditional dividend discount model works surprisingly well if you adjust your inputs, the return equity, the growth rate, and the risk to reflect the bank. However, we know lots of banks don't do the right thing. What I mean by that is what they pay out is not what they can afford to pay out. And with regular companies, that's why we use free cash flow to equity and free cash flow to the firm, because we say we can't trust what companies return. We have to look at what they could have returned. So starting about 2 years ago, I started thinking about how do I come up with the free cash flow to equity for a bank. And I kind of gave you a little bit of flavor of this. When I said, when I think about a bank reinvesting, I don't think about land and building and equipment and capex and working capital. I think about investment in regulatory capital, because you can't grow if you don't invest in regulatory capital. So I'm going to define what you reinvested regulatory capital as the equivalent of your reinvestment. So if I take net income and subtract out the reinvestment in regulatory capital, I'm going to come up with the free cash flow to equity. If I discount that free cash flow to equity, I'm actually discounting something much more sensible. So this is for valuation I did of Deutsche in 2009. It was actually my first try at valuing a bank using this approach. So I started with the net income, which I estimated by looking at the return equity and the book equity. I also estimated, they gave the regulatory capital ratio. I made a judgment on what that number would converge on and used that to come up with the regulatory capital each year. And see this line item? Change in regulatory capital, 1,146 million euros. That's actually the equivalent of my reinvestment. I subtract that from my net income. I come up with my free cash flow to equity. I discount those free cash flows to equity instead of the dividends. And that gives me my value per share. Let me ask you a question. Can that free cash flow to equity be negative for a bank? Sure, right? It'll be negative either for high growth banks, which need to grow their regulatory capital a great deal, or for, what's the other scenario where you're going to need a lot of regulatory capital? If you're an undercapitalized bank, right? So if you ask me to value Santander, I'll probably have negative cash flows, even though they pay a dividend. I don't trust the dividend because the dividend is coming in through one window, going out of the other. It's a much more flexible way of valuing banks, but it does mean that you have to get conversant with regulatory. Tier 1, it's a pain in the neck. I hate doing it. But the reality is, if you're going to invest in banks now, you have no choice. You have to get at least reasonably comfortable with what those ratios are and what they're measuring. So here's my valuation of Deutsche in March of 2009. So with those free cash flows equity discounted back, the value per share that I got was about 54. Stock was at 48, well below the 89 it was before the crisis, but it wasn't a bargain anymore because the amount of regulatory capital they would need to keep going was eating away enough of the cash flows that it got reflected in there. The one final thing I'm working with banks is I've for a long time used the levered beta for banks, for all banks in the sector. I'm working on some way of connecting my levered beta to your regulatory capital ratio. Because remember at the start of the class I said if you have a lot of regulatory capital, I want to give you a lower cost of equity. If I can somehow connect your cost of equity to regulatory capital, I can start to reward well-capitalized banks by giving them a lower cost of equity. And I don't do that enough now. But it's something, again, that I've started doing post-2008 that I never did before. Okay. Any questions on financial service companies? So banks, investment banks, insurance companies, this is basically what's going to drive. So let's pause there. When we start on Wednesday, we will start with pharmaceutical companies and technology companies.
That's what's going to allow them to continue to be competitive. Like when you see competition driving on the
Still not sure. I'm not sure about this future state. How can I reasonably settle both of those two numbers because they change in different directions?
It's a difference in return on capital and cost of capital. You talk about return on capital and investment.
Yes.
Okay, it's a company in the business without
so at least you can give me some clues to figure out.
They're in a big market. Obviously, you're going to reinvest with less competition, a bigger market, you get more clues. If you have lots of competition, the market is already getting tight.
Because I'm now valuing a company listed in China.
Again, if you think of the, so basically it boils down to how big is the market, what's the competition, is there room for you to grow?
Because I traced the past 4 years. That's matter. Because it increases your investment rate.
See, if your answer today in those 4 years of numbers, then I don't need an Excel spreadsheet to basically project the results. The reason you need human intervention is you have to take those 4 years of numbers, you have to look at the market, you have to look at the competition, you have to make your best judgment on what you think will happen in the future.
But I'm not a professional in those kind of industry. How can I?
If only professionals can value companies in a business, then how are you ever going to invest? What business are you a professional in? Because if that's the answer you're going to, I'm not a professional in cost service business.
You just said that those two numbers have reasonable change directions and that
It really will be company specific.
Yeah, okay. Another question. As for the debt ratio, we always use the market value of the debt ratio, right? But in some not that mature market, the market price is not that reasonable according to that intrinsic value. Should I use the book value debt ratio? Even those.
Hi. Oh, good. You're probably. Do you have some time?
Actually, I have to go to 3 o'clock meeting.
I'm going back to the office to go back to work. Do you think it's best if I just formalize my questions? Because I think I'm just not understanding. And that's like a bigger picture.
I think though you start with this.
Yeah, and then
your fourth